Are you tired of feeling like everyone else is getting rich but not you? Do you want to start a small business but just don't know how? Do you wish you had a better understanding of business, finance, and investing? Well, look no further. In this video, we're diving deep into the basics of how money works in a small business and why it's crucial to learn this early on. Trust us, the knowledge you gain today will set you up for a lifetime of financial success and confidence. Don't wait any longer to take control of your finances. Here's everything you need to know about business finance and investing, Part 1. Welcome to Knowledge Pilot. Let's start off by assuming that your grandmother makes the best iced tea and you want to start a company selling her iced tea in a market stand. You don't have any money right now, so you'll have to find investors to get the business off the ground. So how are you supposed to do that? Chapter 1. Setting up a corporation. You come up with a name for your business and fill out a form with the state called a filing. We'll call your company Granny's Iced Tea Stand, and outside investors will contribute to your operations. You need a little capital to get started, so you'll start with 1,000 shares of stocks. You'll sell 500 more shares to an investor friend of yours for $1 each. Your friend will invest $500. You're bringing to the business the name, the idea, and your granny's secret recipe, so you're going to give yourself 1,000 shares. The investor is going to have 500 shares. For $500, he gets 30% of the business. What's your startup value? $1,500. You have $500 in the bank plus $1,000 because I came up with the idea for the business. I'll need more than $500, so what should I do? Well, it's time for me to take out a loan. I'm going to borrow $250 from a friend and pay him 10% interest a year. Now, why do you borrow money instead of just selling more stocks? Borrowing money lets you hold more shares, so if the business succeeds, you'll get a greater share of the earnings. Chapter 2. What is the balance sheet? So, let's see what the business looks like on paper. You're going to have something called a balance sheet. A balance sheet tells you where your company stands, what your assets and liabilities are, and what your net worth or shareholder equity is. This is how it's done. If you take your assets, in this case, you've made $500. You also have something called goodwill, because you've said that the person who puts up the $500 only got a third of the business, and the other 2/3 is ours because you started the business. Now the 2/3 portion is something that represents the real but intangible value of the company, like its secret iced tea recipes, great customer service, even future loyal customer base, and future brand reputation. This intangible value is known as goodwill, and it is worth something. That gives the business $1,000 in goodwill. You got a loan of $250. You will have to pay $250, which is classified as a liability. You have $500 in cash from selling stock to your investor, $250 from the loan, and $250 in debt. You therefore have a company with $1,500 in shareholders' equity. Chapter 3. What do you need to start the company? You need an iced tea stand. You'll pay $300 for that. That's a fixed asset. Unlike tea, sugar, or water, this is more like a building that you buy and put together. It loses its value over time, but it is a fixed asset. Next is inventory. What's needed to make iced tea? Sugar, water, tea, Granny's secret ingredients, and some cups. You'll need some containers, napkins, and enough ingredients to make 50 gallons of iced tea at the start of your business. All that will cost $200. Now 50 gallons gets you about 800 cups of iced tea and you're ready to begin. Check the balance sheet again. You spent $500 on supplies. You have $300 in fixed assets, which is your iced tea stand, and you still have $250 cash in the bank. Inventory is $200. Those are the iced tea ingredients. Goodwill is still $1,000. Therefore, you have $1,750 in assets, but you still owe $250 to the lender. This leaves you with $1,500. Same as at the start. You haven't made money because shareholder equity hasn't changed. You just transformed cash into assets you need for your iced tea stand company. Now let's speculate about your business future. Chapter 4. What is the income statement? The income statement shows how profitable the business is, how much money it made, how much it spent, and how much money is left over for the owner. You estimate 800 iced tea sales each year. That's not huge, but you should probably assume that the iced tea business is pretty seasonal. Iced tea sales peak in summer and are negligible in the winter. You estimate a $1 per cup price and $10 per week, or $530 per year for the salesperson to work your iced tea stand. So let's build the income statement. You've got one iced tea stand. At your stand, you sell 800 cups of iced tea. You charge $1 per cup, which means you make about $800 a year in sales. You spend $200 on inventory, which is also known as the cost of goods sold or COGS. You have depreciation because your iced tea stand wears out over time and loses all its value over 5 years, which equates to $60 per year for depreciation. You have to pay the salesperson $530 per year to pour the iced tea and collect money from the customers, which leaves a profit, also known as earnings before interest and taxes, EBIT, of $10. That's about how much money the business made before taxes. You didn't make very much money if you compare that $10 profit before taxes to how much money you made. It is a 1.25% profit margin. That's not a huge amount of profit. Don't forget that you must pay that 10% interest on your $250 loan, which is $25 per year. This means that your business will lose $15 each year. So, is this business any good? You're losing money and your cash is decreasing. Chapter 5. Growth Projections. Is this business worth staying in? You lost money the first year. Is it time to give up? Let's predict the company's future. Let's say you utilize all the business capital to acquire more iced tea booths to expand. Let's assume you're not going to take any money out of the company and you're not going to pay a dividend. You're going to keep all the money in the company and reinvest it. Let's say that as you establish your brand, you can charge 5 cents more for each cup of iced tea each year and sell 5% more cups every stand. So you've built in growth assumptions. Now let's look at the business. In year 1, you had one iced tea stand. Because of your enormous expansion strategy, you add 1 a year and then 3 more in the 5th year, where you reach 7 stands by year 5. Your revenue grows from $800 in year 1 to over $8,000 by year 5 as your iced tea prices rise 5 cents a year and you open more stands. By year 5, you make over $8,000. The tea and sugar are pretty much all you have to pay for. That is about $1,702. When more stands wear out, you depreciate them each $60 a year. You have to pay for labor. You increase your margin from 1.25% to over 28%. The business is now up to speed. You're starting to cover some of your expenses. You're growing. You're still paying $25 a year in interest on your loan. And by the end of year 5, your earnings before taxes and interest add up to $2,300. So you gave the business $500. You borrowed $250. And after 5 years, you've made $2,300. It's looking like a good business. The government now wants us to pay taxes. That's about 35%, and by the end of the 5th year, you'll have a net income or profits of $1,500, which is about $1 per share. So if you think about it, your friend invested $500 to buy 500 shares of stocks. He paid $1 per share. And if your business goes as planned, he will make $1 per share after 5 years. That means he will be doubling his money. That sounds like a pretty good deal. So, how has it changed? You have been able to build a successful business because of how quickly you have grown over time. Now, these are just estimates, but if they are accurate, you might want to start or invest in this business. Now, let's look at the cash flow statement. So as the business becomes more and more profitable, you make more and more cash. Over the period, you go from having $500 in cash in the business to having more than $2,000. The shareholders' equity was $1,490 when the balance sheet was first made. But as the business makes more money, the profits add to the cash. Our liabilities have not changed, and the business continues to build value over time. So again, by the end of year 5, you've got nearly $4,000 of shareholder equity. And that's almost 3 times what it was when you started. Wow, that was a heck of a ride for your business. This is just the first part of this 4-part series. In the next video, you will learn how to evaluate if this is a good business or a bad business. So check out part 2 of this series. We're going to wrap things up here for today. We hope you liked this video. If you want more information on this, check out our other videos on the screen. Thank you for watching.